Imagine, for just a second, that you're looking over the financial blueprints for a major technology company. And the numbers you're looking at are just, well, they're completely mind-bending.
Yeah, totally contradictory.
Right. Like on the very first page, you see an organization experiencing the kind of hypergrowth that, most founders only dream about. I mean, the revenue is exploding, they've secured literal mountains of guaranteed future contracts, and they're partnered with the single most important hardware manufacturer on the planet.
It looks like the ultimate generational wealth creator. You see those top-line numbers and you think, wow, I am looking at the next great titan of the tech industry.
Exactly. But then, and this is where it gets crazy, you flip to the next page, and the story just completely fractures.
Yeah, it falls apart.
Because sitting right beneath that unprecedented growth is a quarterly financial loss that would honestly bankrupt a normal business. And it is paired with a debt load so massive it almost looks like a typo.
It really does look like a mistake.
Well, welcome to Market Pulse Daily. Today, we are looking at CoreWeave, and specifically their Q2 2026 Equity Research Report. Our mission today for you, the listener, is to untangle this exact paradox.
Right. We need to figure out if CoreWeave is executing this brilliant, visionary land grab in the AI infrastructure space.
Or if they are building a wildly leveraged financial house of cards that could just collapse under its own weight.
Which is a very real possibility. It really is the ultimate Rorschach test for the current market environment.
It is. Now, before we get into the actual numbers, which are wild, we want to give a quick shout out to StockOracle.
Yes, definitely.
StockOracle is an AI-aided stock research platform. It is great for fundamentals, valuation estimates, moat analysis, bull and bear insights, comparisons, watch lists, and portfolio research.
It really helps cut through the noise when you're looking at complex situations like the one we're discussing today.
Exactly. But we do have to remind you that StockOracle is not financial advice.
Right, not at all.
It is not a buy or sell recommendation, it's not a trading signal service, and it does not provide real-time market data. Plus, AI insights and valuation estimates can be incomplete or wrong.
Yeah, the data may be delayed, so always make sure important facts are verified on your own.
Always. And just full disclosure, we do have a special 14-day trial link for StockOracle down below in the description. It is an affiliate link, so the channel may earn a commission at no extra cost to you.
Definitely go check that out if you want to dig into the fundamentals yourself.
All right, so let's get into the actual catalyst here.
Yeah.
Because the demand side of this story is just incredibly powerful. When this Q2 earnings data dropped, the market just went wild.
Oh, absolutely wild.
So walk us through the actual numbers here. Just how fast is CoreWeave actually growing?
It's staggering, honestly. Their Q2 revenue came in at $2.58 billion.
Wow.
Right. To put that in perspective, that is a 112% increase year over year.
That's insane. Over 100%.
Yeah, and they comfortably beat consensus estimates. But the thing that really grabbed the market's attention was their forward-looking confidence. They actually raised their full year 2026 revenue guidance to a range of $12.4 to $13.2 billion.
That's a massive jump.
It is. And for the upcoming third quarter, they're projecting revenue around $3.4 to $3.6 billion, which implies a growth rate of around 158%.
Okay, so we have a company literally doubling, almost tripling its revenue in a matter of months. But top-line growth is only part of the story, right?
There's more to it.
The thing that really jumped out to me in this research was the backlog. What is the actual scale of these future commitments they have locked in?
The backlog is arguably the single most important metric we are looking at today. CoreWeave currently boasts a $104 billion revenue backlog.
$104 billion.
With a B.
With a B.
And that is legally binding, contracted future revenue. And on top of that, they secured over $25 billion in new commitments just in Q3.
Wait, and that $25 billion isn't even fully baked into the original $104 billion number yet.
Exactly, it's on top of it.
Okay, but we aren't talking about verbal agreements from like a handful of unproven Silicon Valley startups, right? Who is actually signing these checks?
You are looking at the absolute vanguard of technology. Meta alone made a total commitment of over $35 billion.
$35 billion from Meta alone.
Yeah, which includes a newly signed $21 billion incremental deal spanning from 2027 all the way to 2032. Plus, you have a massive multi-year deal with Anthropic and a $6 billion commitment from Jane Street.
Jane Street, the quantitative trading powerhouse. That is serious validation.
It really is. The biggest players are locking up space.
So to kind of help make this business model click for you, think about it like this. Imagine CoreWeave is a wildly ambitious real estate developer.
Okay, I like that analogy.
Right. They want to build massive, towering skyscrapers. Except in this case, the skyscrapers are highly specialized data centers, packed to the brim with incredibly expensive NVIDIA GPUs.
Right, the hottest commodity on Earth right now.
Exactly. Now, they are building all of this using a mountain of borrowed money. But before they even pour a single ounce of concrete, they already have ironclad multi-year leases signed by the biggest, richest tech giants in the world.
That is a highly accurate way to look at it. They are an infrastructure developer taking on the upfront capital expenditure risk, right, to build the physical home for AI.
Yeah, that makes sense.
And they have a unique partnership with NVIDIA that gives them a highly differentiated position. They get priority access to the specialized chips everyone desperately wants, they design the intricate cooling and power systems, and then they rent out that compute power.
But that brings up a glaring question for me. If Meta is sitting on tens of billions of dollars in cash,
Which they are.
right, why on earth would they sign a $35 billion lease with a middleman? Why doesn't Mark Zuckerberg just buy the NVIDIA chips and build his own data center?
Well, it really comes down to speed to market and capital allocation.
Okay, how so?
Building a specialized GPU data center is not like building a traditional server farm. The power grid requirements are massive. The liquid cooling logistics are intensely complex. CoreWeave does absolutely nothing but this.
So they are specialists.
Exactly. By outsourcing to them, Meta gets access to optimized infrastructure way faster than if they permitted and built it from scratch themselves.
That makes total sense. Buying speed.
Right. And it allows Meta to turn a massive upfront capital expenditure into an operating expense spread out over, half a decade.
Okay, so they are buying speed and convenience.
Yeah.
But here is where the market sentiment and the fundamentals start to get really complicated.
Well, this is the catch.
You see that $104 billion backlog, you see the Meta contracts, and you naturally assume this company is an unstoppable monopoly. But Morningstar assigns CoreWeave a no-moat rating.
Literally no competitive advantage.
How is that even possible with these numbers?
It sounds contradictory, I know, but the logic is actually sound when you step back and look at the broader battlefield. CoreWeave is going toe-to-toe with the hyperscalers.
You mean Amazon, Google, Microsoft?
Exactly. These are absolute titans. And the critical difference is that Amazon, Google, and Microsoft have massive cash printing core businesses.
Right. E-commerce, search, software.
Yeah, those businesses generate tens of billions in free cash flow every single quarter. So when Amazon wants to buy GPUs, they just use their own cash.
So the hyperscalers are essentially paying with debit, while CoreWeave is maxing out a very specific kind of credit card just to stay in the game.
Precisely. And Morningstar's no-moat rating is based on a metric called return on invested capital.
Okay, explain that a bit.
Well, because CoreWeave is entirely reliant on external funding to keep up with the constant brutal upgrade cycle of new AI chips, their return struggles to meaningfully exceed the massive cost of acquiring that capital.
Ah, so the money they make doesn't outweigh the cost of borrowing the money they need to buy the chips.
Right. The barriers to entry in AI compute aren't about having a secret algorithmic recipe. They are entirely about having access to capital and chips. And while CoreWeave has the chips right now, their capital comes at a steep, steep price.
Which means we really need to talk about that price and how they are actually paying for all of this. Because, a $104 billion backlog means you have to physically build $104 billion worth of data centers.
You have to put the hardware in the building.
Right. Let's look at the balance sheet. In Q2 alone, the data notes a GAAP net loss. Could you break down exactly how much they lost?
So the GAAP net loss in GAAP stands for Generally Accepted Accounting Principles, basically the absolute bottom line profitability after every conceivable expense was $626 million for the second quarter.
Over $500 million lost in one quarter.
Yes. And that loss actually widened significantly from $290 million in the same quarter a year earlier.
Okay, hold on. I need to push pause here.
Sure.
Because the research also states that over the last year, their gross margin was 69%.
Right, 69%.
Meaning, for every dollar of compute power they rent out, it only costs them 31 cents in direct operational costs like electricity or basic facility upkeep. If they are keeping 69 cents on the dollar at the gross level, how on earth are they losing over $600 million on the bottom line?
It's the multi-million-dollar question.
What is literally eating all of that cash?
It's a brilliant question, and it cuts to the heart of their business model. The massive gap between their gross margin and their deeply negative 25% net margin comes down to two massive expenses.
Okay, what are they?
Depreciation and interest. First, GPUs are not like real estate. They don't appreciate in value. A top-tier chip today is obsolete in a few years.
Right, the hardware goes stale fast.
Exactly. So they have to take massive accounting charges for the rapidly declining value of their hardware. But the second, and arguably more dangerous expense, is the debt servicing. Yes. As of the end of Q2 2026, CoreWeave is carrying $35 billion in debt.
$35 billion, that is staggering.
And Morningstar estimates that total could roughly double to $40 billion by year-end. They spent $15 billion on capital expenditures in just the last 2 quarters alone.
Wow.
And they've raised their full year 2026 CapEx forecast to somewhere between $35 and $39 billion.
$35 billion in debt. I really want to make sure we truly understand the scale of that leverage. There is a specific ratio regarding their debt. What is that metric, and how does it compare to a normal company?
The metric is net debt to adjusted EBITDA, and EBITDA is earnings before interest, taxes, depreciation, and amortization. It's basically a rough snapshot of the cash the core business generates before the finance department gets involved. CoreWeave's ratio is sitting at approximately 9x.
9x.
Yeah. To put that in perspective, a typical healthy, mature tech company might sit at a 1x or 2x ratio. Hitting 9x makes CoreWeave one of the most highly leveraged technology companies in existence.
So I have to ask the obvious question then. How does a company even service $35 billion in debt when their bottom line is negative 25%?
Yeah.
Like, how do you pay the mortgage when your paycheck is effectively negative? Are traditional banks actually underwriting this?
Oh, traditional banks would run away from this, which is why CoreWeave is utilizing highly specific financing mechanisms. They aren't getting standard corporate loans.
What are they getting?
Instead, they are relying heavily on delayed draw term loans, or DDTLs.
DDTLs, okay.
Yeah, they recently secured an $8.5 billion DDTL facility at a 6% interest rate. They've also issued billions in convertible senior notes.
Okay, a delayed draw term loan. Let's kind of demystify that for everyone. What does that actually mean for their day-to-day operations?
Think of it as a pre-approved massive line of credit that you can pull from over time as you need to buy equipment, rather than taking one giant lump sum on day one and paying interest on money just sitting in the bank.
That makes sense. You only borrow what you need when you need it.
Right. But here is the critical part. These loans are largely secured by those take-or-pay customer contracts we talked about earlier.
Ah, take or pay. Explain how that works as collateral.
Okay, so when Meta signs that $35 billion contract, they agree to a take-or-pay structure. This means Meta is legally obligated to pay CoreWeave whether they actually utilize all the compute power or not.
Oh, wow. So they pay no matter what.
Exactly. So the lenders look at that legally binding commitment from one of the most profitable companies on Earth and say, well, okay, we will lend you the billions to buy the GPUs, because Meta's balance sheet is essentially guaranteeing the revenue.
So Meta is indirectly acting as like the rich uncle co-signing the loan for CoreWeave's expansion.
That is a perfect way to describe it. But this structure introduces a terrifying variable that is entirely out of CoreWeave's control.
Which is?
Interest rates. Morningstar explicitly warns that a few hundred basis points increase, which just means a 2 or 3% hike in interest rates on these loans, could literally break CoreWeave's business model.
Wait, just a 2 or 3% shift in rates could break the entire company?
Yes. Because they're operating with so much debt and such deeply negative net margins, they have absolutely zero cushion.
No room for error.
None. If the cost of servicing that $35 billion debt spikes by just a few percentage points, the added interest expense alone would consume whatever future operating profit they hoped to generate.
That's terrifying.
In that scenario, Morningstar warns the equity value could be driven to zero. The creditors would effectively take over whatever is left. They are entirely reliant on the macroeconomic environment cooperating while they try to grow out of this debt.
That is incredibly precarious. So shifting gears to market sentiment. How is the stock market attempting to price a company that is simultaneously growing by over 150% and sitting on the edge of a debt cliff? Because looking at the stock price action, it feels a bit like financial schizophrenia.
Oh, the volatility is completely off the charts. Immediately after this Q2 earnings release, the stock popped over 19%, closing at $107.73.
Right.
The algorithmic traders and growth investors saw the revenue beat and the raised guidance, and they just slammed the buy button.
But if we zoom out, context is everything here. Because even with that massive 19% pop, the stock is still nearly 30% below its October 2025 high of $153.20.
Yeah, people forget it was way higher.
Right. In fact, before this earnings report came out, it was down 40%. The data mentions the stock has a beta of 3.07. For you listening, a beta of 1 means a stock moves in lockstep with the broader market.
So a 3 is huge.
Yeah, a beta of 3 basically means if the broader market sneezes, CoreWeave catches pneumonia. It's moving 3 times as violently as the rest of the market in both directions.
And you see this exact same whiplash in the analyst community. The professional analysts are entirely fractured on this.
How far apart are they?
I mean, you have Truist Securities raising their price target to $155 with a strong buy rating, focusing entirely on that massive AI infrastructure demand.
Right, the bull case.
Yeah. But then you have Morningstar valuing it around $97 to $106, slapping a very high uncertainty rating on it.
And it gets even wilder if you look at individual contributors on platforms. You have one analyst screaming strong buy with a $266 price target, pointing to the $104 billion backlog as proof of concept.
Which is valid.
Right, and literally right next to them, another analyst is issuing a strong sell, warning about the structural credit risks. It seems like nobody actually agrees on what this enterprise is worth. We obviously aren't giving any buy, hold, or sell ratings here, but you can see the massive divide.
Oh, totally. But amidst all of that noise, all the debates over moats and margins, there is one purely objective data point in this research that acts as a massive, glaring red flag.
The insider selling. This part of the data is just staggering to me.
It really is. Over the last 90 days, insider net share sales totaled approximately 20.6 million shares.
20 million shares.
Yeah. We are talking about 1,091 individual sell transactions from company insiders compared to just 101 buys.
Okay, I have to stop here, because this is the glaring contradiction that makes no sense to me.
Yeah.
If the $104 billion backlog is so rock solid, and the NVIDIA partnership is impenetrable, and management is literally raising future guidance, why are the executives and insiders rushing for the exits and cashing out 20 million shares?
It's a great question.
Like, what do they know that the retail investor buying the post-earnings pop doesn't know? Is this just normal corporate behavior, like,
Right.
Executives selling to pay taxes?
That is the multi-billion-dollar question. And to answer yours, no. This volume of selling goes far beyond routine tax management or, a CEO buying a new house.
Right, 1,000 sell transactions is wild.
Exactly. 1,091 transactions is a coordinated structural de-risking. While that post-earnings stock jump looks like a bullish reversal to an outside investor, persistent insider selling at this scale is a heavy, moderate to severe risk signal.
So what is the psychological read here? Why bail out if you're building the future of AI?
Because the insiders are intimately, painfully aware of that $35 billion debt load. They see the daily fragility of the take-or-pay financing model.
They know exactly how tight the margins are.
Exactly. The broader market might be temporarily blinded by the AI hype and the shiny revenue growth, but the people inside the company are actively taking chips off the table. They're locking in their personal wealth right now, rather than betting their entire net worth on the company flawlessly executing a high-wire financial act for the next 5 years.
Wow. It's like the architects of this massive skyscraper are quietly strapping on parachutes, all while they are giving press conferences telling everyone else how great the view is going to be from the penthouse.
It's a sobering visualization, but it perfectly fits the data. It tells you that the people with the most visibility into the company's daily operations are simply not willing to bet their own futures on the macroeconomic environment staying perfectly stable.
Okay, so let's pull all of these pros and cons together.
Yeah.
Because CoreWeave is clearly a company defined by absolute extremes. On one hand, the upside case, the demand story, is incredibly tangible.
Very real.
Right. You don't get Meta and Anthropic and Jane Street to sign legally binding contracts for tens of billions of dollars if your infrastructure isn't fundamentally crucial to their survival.
The demand is real, the revenue is real. That backlog provides incredible multi-year visibility that most companies would absolutely kill for.
But the downside risks, the dark side of the moon here, is that their financial foundation requires absolute perfection.
Yes.
They need flawless operational execution, they need the interest rate environment to remain stable or even go down, and they need the hyperscalers to not suddenly decide to crush them on pricing. They have absolutely zero room for error.
So as you look ahead, the data gives us the exact metrics to watch to see how this plays out. Q3 earnings are expected in November 2026.
Right.
Management is targeting 3.4 to 3.6 billion in revenue. But honestly, the revenue number is just a distraction at this point.
Right, because we already know they can grow top-line revenue by spending billions of borrowed dollars to buy chips. Spending money is the easy part. What is the actual metric that matters?
The real test in November is their adjusted operating margin. Right now, it is sitting at an absolute trough of around 1%.
1%, wow.
Yeah. The market desperately needs to see that margin expand. It needs to start moving toward 5%. If they can show that their massive scale is actually starting to generate real expanding operating profit, then the debt finance model starts to look sustainable.
They have to prove that getting bigger actually makes them more profitable, not just deeper in debt.
Exactly. And if they miss on that margin expansion,
What happens then?
if they miss, or if we see any contraction in that $104 billion backlog, for example, if a major customer tries to renegotiate away from a take-or-pay structure to a flexible pay-as-you-go model,
The whole thing shakes.
the entire house of cards wobbles. Their ability to secure new financing dries up instantly, and the bear case scenario becomes the reality very, very quickly.
Which leaves us with a much larger, lingering outlook to mull over here.
Yeah.
We've talked extensively about CoreWeave's survival, depending entirely on these massive take-or-pay infrastructure contracts.
Right.
They are borrowing tens of billions today based on the ironclad promise that Meta and others will pay them tens of billions tomorrow.
And that model relies entirely on the assumption that Meta will always have the billions of dollars in free cash flow to pay them.
Precisely. So what happens to CoreWeave? And honestly, what happens to the broader global economy? If the tech giants suddenly realize that artificial intelligence just isn't generating enough end-user profit to justify those multi-billion-dollar leases.
It's the scary question nobody wants to ask.
Exactly.
Yeah.
We always talk about software bubbles popping where, an app loses its users. But what if the AI bubble doesn't pop at the software level? What if it collapses under the sheer crushing weight of the $35 billion in debt financing the physical hardware?
It is, without exaggeration, the ultimate high-stakes gamble on the future of technology.
It really is. Something to think about the next time you ask an AI chatbot to write you a grocery list or, draft an email. Someone, somewhere, took out a multi-billion-dollar loan at a 6% interest rate just to make that happen.
It's crazy to think about.
It is. Well, before we wrap up today's Market Pulse Daily, just a quick reminder for you to hit that subscribe button so you never miss an analysis.
And don't forget to check out the special 14-day trial link for StockOracle in the description below.
Yes, StockOracle is a fantastic AI-aided platform for fundamentals, valuation estimates, and portfolio research. Again, it's not financial advice or real-time market data. And remember to always verify facts, as AI insights can sometimes be incomplete. It's an affiliate link, so the channel may earn a commission at no extra cost to you.
I don't recommend giving it a look.
Thanks for tuning in, and we will catch you on the next one.